Hello and welcome to interest.co.nz. I'm Gareth Vaughan and I'm here with another of our double shot interviews. I'm joined by Daniel Bean, who is the Head of Foreign Exchange Research at ANZ, based in Sydney, visiting New Zealand this week. Thanks, Daniel, for coming in. It's
good to meet you.
Thanks
for the invitation.
Look, it's a very turbulent world out there in financial markets, so it's a good opportunity to have a chat with you about all this. I just thought I might kick off by asking you, just looking at what's going on in New Zealand and Australia at the moment. Obviously, RBNZ has cut the OCR to 1%. RBA's already there in Australia at 1%. I guess with the global financial crisis going back a decade, we saw the US, we saw Europe, and obviously Japan with its long-running issues tumbling to very low interest rates, negative rates in some instances. We down here thought we'd avoided all of that. I'm just wondering, why are we now heading into these uncharted low interest rates?
It's a good question, and I think there are two things that can explain this to us. I think the first is the response that we had from China to the crisis. So in 2008, just as the world kind of came to terms with the scale of the decline in the US, one of the most extraordinary things we saw was China basically went all in. They stimulated their economy in a fairly indiscriminate fashion, deciding that growth, no matter the quality, the type, or whatever else it might be, was the target to go after. And sitting in this region for Australia and New Zealand, obviously that provided us with a pretty reasonable cushion and an offset to the troubles that we were seeing in the other parts of the world. So that was the first thing that really saved us. And when you look at terms of trade, it kind of highlights that point. The other thing, though, is our banking systems at the time were far more resilient. And the fact that, on mortgages in Australia and New Zealand, you couldn't just hand back the keys and run away. And so you didn't have that wave of defaults in the market, and you hadn't had the build, and you didn't have the imbalances in the financial sector because you hadn't had the same degree of regulation, also meant that just the balance that we had in these countries were better. Why now, I guess, is a separate question. And I think partially that comes to a lack of patience, or not a lack of patience, but a test of credibility of targets. So you go back to 2008 and all of these countries were reacting to what they were seeing in the immediate future. When I look at central bank policy at the moment, I think that a lot of what we're reacting to is not only what we're seeing in the immediate future, but the failings that we've seen in the last 3 or 4 years or 5 years. We haven't seen inflation hit target in Australia for a number of years now. We've seen employment growth across the world without wages growth coming through. And I think as inflation targeting central banks, whose ultimate mandate is to, get inflation into target over the medium term, the issue that they have is, and the governor of the Reserve Bank said it perfectly when he said, we have flexibility around our target, but flexibility only runs so far. And I think we've reached this point where the balance between patience and flexibility and credibility is really starting to come to a head for these central banks. And I think that's the primary difference as well, is that the reaction functions and the patience have changed because we've had such a long recovery which hasn't really taken us anywhere.
Yeah, I mean, in the past, you might have thought that if Australia and New Zealand had official interest rates at just 1%, that the economies would be mired in a deep recession. But obviously, Australia hasn't had a recession since the early 1990s. We're certainly not in one in New Zealand, even though the economy has slowed down. Is this a case of perhaps our reserve banks needing different mandates? Do they need to change things? I mean, both the RBA governor recently and the Reserve Bank of New Zealand are still telling us that they believe that the monetary policy tools they have work. But do they really?
I think they do, and I think the way I've always thought about monetary policy is that monetary policy is a great tool for smoothing cycles. But ultimately, the responsibility for the direction of the structure of an economy falls to governments and falls to good regulatory policy and those sorts of dynamics. So I think, inflation targeting absolutely has its place, and central banks using it to smooth cycles has worked. There's no doubt that, where we would have been in absence of interest rate adjustments is a far more difficult place. Where we would have been in absence of flexible currency regimes is a very much more difficult place. And the flexibility that that's put into the systems to allow time for governments to actually enact reform is very useful. I guess the challenge that they're up against is that we're in a world where there's an aging demographic, where debt levels are already high, and so the ability for policy to actually have as much of an impact as quickly or as easily as it did in the past is maybe diminished. But to say that there's no role for it anymore, I don't think that that's the case.
Now, on to currencies. Obviously, there's an impact when a central bank cuts its official interest rate by 50 basis points, as ours did last week. There's an impact on the currency there. There's been quite a lot of talk. There's obviously the highly publicised trade war with the US and China going on. There's been quite a lot of talk of currency wars as well, with countries wanting to, have a weaker exchange rate to boost their exports, etc., their trade balance, however you want to put it. Where do you see this panning out? It's obviously an interesting picture at the moment, and we've got the Brexit situation in the UK to throw into the mix just to make it even more interesting. What's going to happen in currency markets in the next? Get your crystal ball out in the next 6 months to a year. Do you think?
Wow. I think some things are absolutely in the process of fairly structural shifts. There's no doubt that, when you look at the US and China, there is a real shift in thinking on both sides about what their future relationship needs to look like and the dynamics around that. Similarly, you look at Korea and Japan at the moment, and they're having a similar conversation. And I think, in a world that has been somewhat deficient of demand over the last few years, where everybody has grown debt quite substantially and where GDP just hasn't managed to really build in a sustainable fashion across the entire world in a consistent way, those tensions are naturally going to rise, because for everyone, they're trying to seek, well, where was my advantage? What happened to it? What could I be doing? And what are other people doing? I don't think that's going away. I think that understanding geopolitical dynamics and understanding the power shifts and those sorts of things are the new economics in terms of currency analysis and in terms of understanding where markets are going. This is what, when I started in currency markets, you cared about this interest rate versus that interest rate, this current account versus that one. And I think that the market to some degree has moved on from that. So the way we've been thinking about the markets is to think about them in a much more holistic and top-down fashion, to look at what are the big drivers, what are the major things that really move currency markets through time in a consistent fashion. And what you find is that really is an understanding of risk appetite and the behaviour of, animal spirits, and it is the direction of the broad US dollar, where that is driven by relative policy as well as its reserve status. So I think really, in looking forward on currencies, it's more a question about where those dynamics are going, rather than it being what central banks are doing and this so-called race to the bottom or currency wars. Because I don't think any central bank is entering this with the view that they are doing it for a war. They all studied economics. They all know about the 1930s. This is not, I don't think, about that. I think it is about recalibrating how you think about the world in a world which has become immeasurably more complex. So in that kind of world, I guess we're still thinking that the US dollar comes out looking pretty good. It still has reasonable yield. Yes, the Federal Reserve is cutting rates as well, but ultimately the absolute level of yield is very good. Despite what we see on Twitter now and then, the overall country has free, open capital accounts. They have deep liquid markets, and the appeal of that in a world of uncertainty, I think, is going to remain. And the ability to undermine that, you need to do something fairly significant. So we still think that the dollar works. We still think that that sort of dynamic makes sense. For the Aussie and the Kiwi, this new interest rate world means that one of the things that used to be a natural support for the two currencies isn't necessarily going to be there anymore. So even though, as we discussed, the economics in both economies aren't a disaster, both are still growing pretty reasonably. Employment growth in Australia today was great. A week or so ago here, it also looked very good. But if that is feeding into a broader interest rate structure which is lower, and if there is no way that you can find where yields are trading above those in the US, while at the same time the global environment looks okay, because you've got to remember Australia and New Zealand are both small cyclical economies. We effectively, are demand takers from the world, price takers from the world. So for the two currencies to rise, I would say you need to start seeing a world where interest rate differentials look better and global growth starts to look better. And for now, we're not predicting a global recession, but growth doesn't look like it's about to pick up rapidly. The risks to that growth with the trade tensions is probably to the downside. And in that context, an investor who's looking around and then sees, well, we've got all of this cyclicality and we're not getting yield relative to the US or somewhere else with deep liquid markets, why would our money go there? So in that sort of environment, we still think that the dollar comes out looking pretty good, particularly against the Aussie and the Kiwi.
Great. Well, look, thanks a lot for that, Daniel. It's Daniel Bean, who's the Head of Foreign Exchange Research at ANZ, and I'm Gareth Vaughan at interest.co.nz.